Swanda, are you able to use the chat function?
No, I just tried to use the chat and it looks like we can't chat with attendees for some reason. It just panelists.
Let's see.
Now we also have the Q&A, so they may be able to ask questions in the Q&A.
Stop sharing my screen really quick and go into my Zoom.
Okay, there was just a question. Can you see my question? And I can. So I can see the questions in the Q&A.
Okay.
So that we may have to use the Q&A instead of the chat tonight.
I have a feeling we are going to have to, since I already started the webinar.
Okay.
We will roll with it. Oh, let's see.
Hello, everyone. Hopefully everybody can hear us okay.
All right, well, we'll have everybody put their questions in the Q&A box, since I am not exactly sure what's going on with the chat function right now. But for those of you that are here, I love interactive webinars. I wish these were in person, so that way we could interact face to face, but I love asking questions. And so if everyone who's in attendance tonight would be able to answer them or type out something in that Q&A box, that would be phenomenal. So that way I don't have to stare at my camera awkwardly after asking the question. Let's see. It is 5:05, so we'll go ahead and get started. The way that this is laid out is we are going to do introductions, so that way you know who is speaking to you tonight. Oh, and I have one that just came across the chat.
I think it was just me.
Oh, darn it.
I was testing it out. I was trying, keeping my fingers crossed, but I think it's just that.
Okay. So we'll do introductions first off. We will do the objectives, and then I have a question right after that. Hint, hint, get that Q&A box up for me, please. And so before we get started, drop an emoji in the Q&A box of how today is going. Hopefully I'll let you do that. Maybe it won't. I was hoping it would, but hopefully everybody's having a good day so far. We'll go ahead and get started. This is the Path to Ownership Part 4. So hopefully you were here with us for the first 3 parts. If not, they are up on YouTube, courtesy of First Financial Bank for doing that. I am Dr. Amber Howarth. I work for Blue Heron Consulting in the startup and acquisition division. And basically that means I help people who either are starting from literally the ground up, sometimes on their dream hospital, their future dream, or acquire an existing practice, and anywhere from ground zero all the way up to, right before opening. We've helped clients in all different stages with that. And so it's been a lot of fun. We've helped a lot of clients so far and hope to continue to do so in the future. I also am a part of a startup myself, currently in Arizona. And so that has been a lot of fun on the side as well. And I will hand it over to Swanda for her introduction.
Yeah, hello. Thank you, Amber. So I am Swanda Flowers, and I'm the managing director of our professional services division at First Financial Bank. And so we specialize in small business loans, and we are focused in a couple of areas, but one specifically is veterinary practices. So, we are excited to be a part of this. I'm actually a pharmacist, as you can see on the screen. So by training, I owned a community pharmacy, and we also are very active in the pharmacy space as well. But I know what that feels like to do a startup. I've been there and done that, and it is a privilege now that we get to help professionals like you listening today to really realize their dream of ownership. And so hopefully we can be a resource to you, not only tonight during the webinar, but also just moving forward as you begin to think through the process and make your plan, whatever step you are, wherever you are in that process. We'd love to help you out. So
Perfect. We will go ahead and jump into our key insights for everybody tonight. So we're going to discuss what an earns versus turns model is and exactly what they are. When I first got told, an earns versus turns model, I looked at the person and said, what are you talking about? It doesn't make any sense. And so as we continue on, we're going to go through the pros, the cons of each earns versus turns, how you can be successful in each, because there isn't one model that fits everybody. And Swanda is also going to go through some of the cash flows behind the earns versus turns models, what the bank is looking for, and how to be successful financially in both models. So with our participants tonight, does anybody know what I mean when I say earns? And I'm hoping that the Q&A function is working for everybody. If anybody is willing to give a stab at it, even if you don't know what it means, you're more than welcome to share. All right, man, tough crowd tonight. We all need some coffee refills, something. So I will just keep going on here, but your earns model means high touch, low volume. And what that means is usually in this type of practice, this type of model, things are going to be a little bit higher costing and the medicine wise. So, you're really thoroughly working up all of your internal medicine cases, your surgical cases whatever that looks like for that patient. And you have a higher touch in the exam room. So usually you're spending a good amount of time in there conversing with the owner, developing that relationship, getting to know the animal, making sure to really do a thorough exam, explain that out as you go. And so usually because you are doing this higher touch in the exam rooms, that means your overall time in the exam room is going to go up. Most of the time you have 30-minute appointments or even sometimes longer in a model like this. I was going to ask a question here, and I don't know if it's working tonight. And I wanted to see if anybody would be able to figure out some of the pros of an EARNS model, but we will dive into it tonight. So again, to remind everybody, it's this high touch, low volume type of clinic. And so that means we usually have a lower volume of cases in these types of clinics, which I have an example a little bit later on. That's not necessarily a bad thing. Sometimes people equate that out to being a bad thing, or the clinic isn't successful or it's not producing enough. And I have an example later on that'll disprove that theory. This also allows for more interaction, like I said earlier, with the DVM and the client. So you can establish those veterinary patient relationships, those client relationships. Hopefully that means the client sending you the Christmas cards or the thank you cards that we really like to get around the holidays. And then again, that means longer appointment times as well. This can also mean that you have better client relationships and the increased compliance component. And so all of us love it when our clients follow through with the directions that we give them. And with this model, that usually seems to be true. And then the last one, but not least, you are basically treating the whole pet. And I picked a dachshund because they are really, really long. And I thought it was a cute depiction of making sure in this model that you are truly treating the whole pet, and not just if they came in for their ear infection, look in the ears real quick and send them out the door. Next, we're going to go to cons, and I was going to ask for participants, but we will do that a different day on a different webinar. And so one of our cons is it can be the lower volume of cases. Like I said earlier too, we'll get to an example that will show you how to calculate out what's too low and what's going to be enough to fit this model. The DVM in the practice alone often isn't enough. You need your staff to be on board with the communication skills, really making sure that you have all of the touch points necessary in the hospital. So for example, that I fall back onto with pet insurance, if you train your front desk staff to either ask the client on the phone or when they're walking through the door, hello, how are you doing? Welcome to our clinic. Does your pet have pet insurance? And if they don't, they can hand a brochure, and that gets the client thinking. And then when they get called back into the exam room, if you train your technical staff to go through the brochure, ask if they have any questions, maybe bring up some facts, that's another touch point. And then finally, when you get in there, you can mention it again and make sure that they're understanding everything, offer a same-day trial, whatever that looks like. So that way there's many touch points and it's a consistent message throughout the hospital. You also want leadership in your hospital. You want the staff taking that on as their role, making sure that if they see something going on, they bring it to someone's attention, that they're really bringing the forefront of medicine to the clients, to you, and really collaborating as a team. So longer appointment times can require that you have a higher, what we call ADT, and that is an average doctor transaction. And this encompasses everything that you do as services that comes from you as the DVM. And so if the client buys pill pockets or greenies or something like that upon checkout, that doesn't really count towards the ADT, the average doctor transaction, because it wasn't necessarily a service that we rendered for them. Same with toenail trims or anal gland expression. If it's something like you took an x-ray, that would definitely count. You ran blood work in-house, that would be something else that counts as well. And then, as always, for either of these models, a con is you have to beware drifting into the middle. These models are very, very specific. They're basically opposites of each other. And if you drift towards the middle and try to appease everybody, it usually does not work out for the best at all. So I caution you against that. Turns. So this picture I felt like depicted turns a little bit. If anybody's ever done a vaccine clinic here, I've done a few vaccine clinics in my day, and you are just getting people in and out. So I thought it was a great representation of what a turns model is. And so it's a high volume, but lower cost clinic. And so, or a lower touch clinic. So most of these are your lower cost clinics, such as vaccine clinics. I've had a couple of clients up in Kentucky that do a really, really good job of this. You have a high volume, that low cost, and you usually have very, very short appointment times because you are trying to get people in and out. For example, when I work in the vaccine clinic, I usually have about anywhere from 5 to 7 minutes with a given patient before I have to see the next one, and I go through that for a couple of hours. Let's talk about some pros. Again, we have a high volume, low touch type of model here. So again, we have a really, really high volume, which can be good in some instances. You're getting people in and out. That means you're having money come into the practice, and you're able to help a lot of different people and animals that come through. And as I go back to that example again, later on in this lecture, you will see exactly how this is going to either help or hinder the practice. So there is less time spent with the clients, which for some people is a really good thing. And for other people, they want to spend more time with the client. So it really just depends on which model you like the best and which one, in this instance, you would be leaning towards. It sometimes can be transactional in nature because you are seeing so many people on a day. Some of these clinics see 30 plus people in a day, depending on the day. And so it can be very fast paced. You also get mastery through repetition, which is why I have a little practice sticky note up here. And so usually when newer grads come out of school, it's not easy for them to just jump right into something like this. And so it can take a while to get the flow down and get in the groove of doing something like this. And then you usually have referrals to other hospitals when you can't handle the caseload, or maybe it's something in one of your protocols that you don't exactly treat. One of the clinics in Kentucky will do ear infections, small eye infections, something that's not super imperative or anything like that with the eyes, maybe like a conjunctivitis, and minor skin issues, and of course vaccines, sometimes spay, neuter, and that's all they allow in their practice. And anything else and above that has to go on to another hospital in order to get whatever it is taken care of. Next up, we have our cons for it. And again, one of our cons can be a higher volume. It can be very fast paced, and it can be very, very quick. Just like we talked about as a pro, sometimes the scope of care can be limited, and that goes back to establishing those boundaries of what you want to do, want to see, what your clinic's able to see and handle, and what you want to refer on. And so one of the tips later on is going to tie all of this in back together. Sometimes your customer loyalty can be a little disturbed because sometimes the customers are only loyal to the price. And when they think that they can go out and find a different price, then they are going to go out and seek that. And so sometimes they're just not loyal to the hospital in that sense. Sometimes there can be blurred lines of responsibility. And so, do I see this? Do I not see this? Do I refer it on to another hospital? How far do we go in this case? What equipment and capability do we have at this clinic? And sometimes our profit margins often come with a price in this model. And I'll explain that out here in a little bit. As well. And it looks like there popped up a Q&A question. So someone put in here, which model is best, earns versus turns? And you're probably not going to like my answer, but both can be successful. And it's truly dependent on what model fits best for you. So hopefully you'll see later on why that is. And I'm sorry if that's not the answer that you were looking for or hoping for, but we will explain out a little bit more in just a second. So this is the page that I was alluding to, and we're going to start with practice A over here. And practice A, the salary is $70,000, which probably in today's day and age is maybe a little bit low depending on where you live in the country. But we are going to roll with it. And so the necessary production in order to cover a salary of $70,000 is $350,000. Most practices use 20% of production is what they like to give their associate DVMs. A lot of practice owners do that too. Sometimes other practices will have it higher or lower, but for the average and purposes of this, we're going to use 20%. And so the hospital that you're at, the average doctor transaction, that ADT is around 230, which is pretty good. If you look at the AHA statistics, they take multiple surveys all across the United States, and currently the average doctor transaction is 187 for the national average. So this hospital is sitting above that national average for their average doctor transaction. And so if we do the math here, our necessary caseload in order to meet this salary, we would divide that $350,000 by the average doctor transaction in order to get our clients per year. So we have 1,500 clients per year after doing that. And if we do that math, that equals 30 per week. And so that's roughly 6 clients per day in this model to equal out their summary or their salary. On the other side over here, we have practice B. We're again going to keep the salary the same at $70,000, and our necessary production again is going to be $350,000 because that's taking 20% of that. This hospital's average doctor transaction is 104. And so with that, it's a little bit below the national average, but that's why it's a national average. People fall above and below it all the time. And so we do the 350,000 divided by their average doctor transaction again to get how many clients per year. And then we get that 67. And then per week, we have about 13.4 clients per day. So you can see how differently the clients per day differs in these two different models. So the one on the right is an earns model, and the one on the right or the left, I'm sorry, my directions are all messed up. The one on the left is a earns model and the one on the right is a turns model. As you can see, the amount of clients that you have to see changes when your average doctor transaction goes up or down. I have a couple tips from some successful practice owners for you. And I always like to start with this one. This concept was earlier in some of the other lectures of starting with your why. And what I mean by that is, why did you get into veterinary medicine? Why did you become a doctor? Why are you wanting to own? What does that look like for you? Getting to that center root. And this is from Simon Sinek's book, Start with Why. And he details out these 3 rings, and I won't get too much into it, but everybody knows what they do and how they do it. But a lot of companies, and the most successful ones, start with why and then work themselves out. Again, being in the middle has come up. In order to truly be successful, you have to delineate yourself either in an earns model or a turns model in order to be successful. I talked about this a little bit earlier too, of defining out your processes. What is your hospital going to see to make sure that you don't have any blurred lines? What is something that you will refer on to the next hospital, whether that be another hospital in your area, or if that's a specialty that animal needs to see? What does that look like? Creating your standard operating procedures, so that way all of your associates, all of the technical staff, everybody knows how this is going to look like. And then you'll also want to look at your demographics. Look at the area. What are your ideal appointment times, your types, your ideal caseload? And then most importantly, what is your ideal client? If you had to sit down today and say, this is my ideal client, and map it out, that'll give you a pretty good idea of if you want to be an earns or turns model. I'm going to hand it over to Swanda now for some cash flow statements.
Yeah, so thank you, Amber. So as we're talking about the type of practice that, either you're in right now, and so, you're trying to figure out, am I really focusing on earns versus turns? One of the things that plays into that is being able to understand your financial statements and what those financial statements tell you. But the first step in that is understanding a couple financial statements just in general. And so we're going to start there. We're going to start by looking at the income statement and the cash flow statements and just describing a little bit about why are they important, what do they tell us, and then how can we use that as you're determining what kind of practice you want to have, and what kind of improvements and efficiencies you want to make to your practice based on your financial statements. So the 3 main financial statements that you're going to be concerned with are going to be, number 1, the balance sheet, second, the income statement, and then third would be a statement of cash flows. So these are the 3 main types of financial statements that every owner should hopefully understand and know how to produce those. A lot of owners depend very heavily on their accountant, their practice manager, and all of those things are fine. But at the end of the day, as the owner, you want to be sure that you understand what these financial statements are telling you, the story that they're telling you about your practice, so that you can continually improve on your business. So we're going to focus on 2 of them during this conversation. We're not really going to touch on the balance sheet. If you are interested in more information about any of these or a balance sheet, we have some resources that will guide you through that. But tonight we'll start with the income statement. And so you may hear a couple of terms used for an income statement. And one is, are they using a cash method or are they using an accrual method? So those are the 2 basic accounting principles that are used when we talk about income statements. And it may sound a little confusing, or, what does that mean? Or why are there 2 different ones? But ultimately, all that is based on the timing of reporting when the revenues and expenses are recognized. And so the cash method is an actual immediate recognition of revenues and expenses. So when a revenue comes in and when a revenue goes out, that is in real time on the income statement. The accrual method will focus on things that are anticipated. Okay, so maybe you haven't actually been paid for those services, but you've rendered the services. So you go ahead and put those into revenues on the income statement, but you haven't actually received the payment yet. Okay, so that's the main difference between the cash method and the accrual method. Either one can be used, but it is important that you know which one is being used by the person producing the documents that you're looking at. So the income statement is also known as the profit and loss, or the P&L. And I would probably say that this is the most important of the financial statements that you're going to need to look at. The income statement gives you, the bottom line, that net income. And everybody said cash is king, but it does matter. So your net income is your bottom line. So that is what you have made after you have paid all your expenses. So revenue minus expenses, okay, including cost of goods, including everything, that is your net income. Okay, and sometimes you'll hear that referred to as your net cash. You may hear it referred to as EBITDA, depending on how that's been calculated on the P&L. But what it tells us is it tells us the record of the business activities for any given period of time. So you can produce a profit and loss statement for a year. You can produce a profit and loss statement for each quarter, each month. And you should definitely be producing them each month to look at those. But every quarter, you should be examining your profit and loss statement and even benchmarking it against national data, just like Amber alluded to. There are some great resources out there. And one of the best ways to determine how healthy your business is to benchmark that against national data. So let's think about what we're going to find on the income statement, okay? And some of the really kind of key performance indicators, key items that we're going to look at on the income statement is going to be number one, the income. Okay, enough said. So revenue, so goods and services, so this is your total revenues, and you need to know that. And there were several calculations that we just looked at. If we've got average doctor transactions, that's going to feed into how many DVMs we need in this practice. Do we have too many? Do we have too few? Based on whether we're an earn versus turn model. And so you need to know your total revenue. Cost of goods sold is something else that's very important, and it's something that you can benchmark against the national data. However, I will tell you, I have probably seen a million different ways and different items that are included in cost of goods or not included in cost of goods. So the important thing with that is that you are consistent and that you understand what you're comparing it to. Okay, but that will be found on your income statement. Next is going to be the gross profit margin. So you're going to subtract your cost of goods sold from your total income, your total revenues, and that's going to give you your gross profit margin. Okay. Now your gross margin does not account for any other expenses other than your cost of goods. So the next thing you're going to find is an outline of all of the expenses. And again, that could be per month. You may print that, run that report per quarter or per year. But you're going to see all the expenses that are being incurred at the clinic. From there, you'll have your operating income and then your net profit. Okay, and net profit is key, and we're going to talk about that more in some slides here to come.
We have one question in the Q&A, Swanda, and I think I'll let you take this one, but we have a question of what is EBITDA?
Yes. Okay. So EBITDA, that's a great question, because when we talk about net profit, there are some times when you can use that interchangeably with EBITDA, but not always. So EBITDA is an acronym, and that stands for earnings before interest, taxes, depreciation, and amortization. And the reason that it's important to make this distinction, because on a profit and loss sheet, on an income statement, you don't always see depreciation or amortization, especially if you're looking at quarterly or monthly profit and loss statements. Those might not always be there, okay? And so depreciation and amortization, they're not fake, they're real accounting principles. However, it's not money that actually comes out of your account. And so in order to determine your true net profit, true cash flow available, you would add those things back. Okay. And so sometimes it's difficult to calculate a true EBITDA unless we can look at the tax returns. So that's a great question. Thank you. Okay, so here's an example of what an income statement, might look like. Okay, so you can see in the first column, you've got, month ended October 31st, 2020. So this would be, 10 month, 1 month for that October. And then in the next column, it's the 10-month total. Okay, and so, you'll be able to produce that income statement each month, and then total it depending on where you are, in the year. This is really important because, and we'll talk about this too, but one of the things you're going to do is you're going to want to look at the tax returns. Well, you might ask, in about August, a lot of folks have filed extensions and there won't be a tax return for the current year. That's when those profit and loss statements really become important, because you do need to know what's been going on in that current fiscal year. And so this is just an example of what that might look like with all of your expenses there. And then your net income or loss, hopefully not, at the bottom. So the next one that we want to talk about is cash flow. Okay, and that's different than that net cash income. Okay, but the cash flow statement is actually the probably least used financial statements, because it is a little bit more mysterious, right? So it is truly a statement of cash flows, and it is changing all the time. So it is real cash coming in, real cash going out, and at any given moment, it will tell us the true liquidity of the business. Okay, so on a profit and loss sheet, you can sort of manipulate those numbers, or you can you might say, oh, it's about this month annually, so we're going to say it's this much, each month on the expenses on an item. And so, that's not always absolutely accurate. And so the cash flow, though, is not easily manipulated. It is truly the cash on hand at any given moment. And that lets us know how liquid your business is. Okay. The information from the income statement and the balance sheet are actually going to flow into the cash flow statement. And that's how we will create that. And so that's an important distinction, that a cash flow statement cannot be used interchangeably with an income statement. Okay, so why are these important? Why do we need to look at this? What is the purpose? And the purpose really is that I would encourage those of you who haven't spent a lot of time looking at financial statements to sort of dig into some and start to figure out, what story these financial statements are telling about the practice. You can glean a lot of information from looking at a series of profit and loss tax returns, cash flow statements, balance sheets. You would be surprised how much you can learn about the clinic and how it operates. You'll easily be able to identify whether that's an earns versus turns. And so, it's really important to look at what story these documents are telling us. Okay, so one of the important items that it tells us is it helps us determine the value of a practice. Okay, and so ultimately, at the end of the day, a practice is worth what a buyer is willing to pay, what the seller is willing to accept, and then obviously what a bank, a lender, is willing to invest or lend on that business. However, there are often times where this can, become an emotional decision, and a seller wants too much, because they've, put blood, sweat, and tears into this practice. or a buyer is willing to pay too much because, they want to be in this location, or, they're just connected with this clinic for one reason or another. So it's important for us to really look at the numbers and determine the value of the practice, not just the potential that we may see in this practice. Okay. And so a couple of things that you want a practice to be able to do: you want the new buyer, okay, to earn market compensation as a DVM. So if we find on a profit and loss statement that in the salaries expense category, they are not paying the owner, who is a practicing DVM, a salary, we need to account for that. Okay. We're going to have to sort of what we call normalize some of those items. Okay. Because we want that buyer to earn market compensation as a DVM. Okay. The other thing that we're going to be looking at on, the financial statements is there enough money left over, that net income, or EBITDA, if we're able to calculate EBITDA, is there enough money left over to service the debt? Okay. Now, we're going to walk through an example here in a minute, but let's just say you had, your debt to me each year was $100. And the clinic produced $100 in net income. Okay. And you're like, okay, well, I can service the debt. That accounts for me paying market compensation. Is that okay? Not really. And the reason that it's not okay is because anything could happen. What we see, interest rates going up. You could have, some sort of a natural disaster that you need to be prepared for. You could lose employees. We could, I hope not, fingers crossed, but, experience something like another pandemic, like we did with COVID, and have to shut down for a time. So what we like to look for is a cash flow and what we call a debt service margin. So the margin over what you're able to service your debt, we want that to be 1.3 or better. So in that example earlier, $100 and $100, that would have been a 1.0. Okay. That would have been a 1.0 debt service margin. We want you to have some wiggle room of about 30%. Okay. That way you're prepared. You can have some money there in the clinic, because you're going to see that margin. You're going to see those extra dollars truly demonstrated on your cash flow statement. Okay. That there's actually cash in the bank in case something like that happened. Okay. So when we're looking at evaluation for practice, here are some things that you're going to need to look for. You're going to need a year-to-date profit and loss statement. So let's just say this was October 31st. Well, let's say right now, okay, November 15th, that profit and loss statement of October 31st would be excellent. It's unlikely they'll have it prepared that quickly. And so it would be fine if you had, end of September profit and loss statement for 2022. You would also want a balance sheet dated for the end of September of 2022. And that's important because although we didn't dive into the balance sheet, what the balance sheet will tell you is how much that practice is in debt. So is their ability to stay flush with cash because it's borrowed funds? Okay, so the balance sheet is very important. You want to look at those liabilities, because as a buyer, you're not going to take on those liabilities. Those are the owner's liabilities. The new buyer is not going to take those on. Okay. So then next you would want 3 years of tax returns. Okay? And it's shocking sometimes that people are not prepared to do that. You likely will need to sign a non-disclosure agreement, a confidentiality agreement, which is perfectly fine, and you should do that because any information that's shared with you is obviously very confidential. But you'll need to see 3 years of tax returns. So when I look at a practice, I'm going to take the average of the last 3 years. Now, you're probably thinking, oh, what, but COVID's in there. What about COVID? We have a trick, around those years that were mostly affected by COVID. Thankfully, you were in an industry that was somewhat pandemic proof. And for the most part, practices rebounded and have done really well through the pandemic. But we are going to want to look at 3 years of tax returns. We don't want to base all of our decision of a value off of one good year or one bad year. Okay, so we're going to want to average the last several years. And then the other things, it's some of the things that, Amber mentioned earlier, is you're looking at what kind this is. These transaction reports will help you determine, is this an earns versus turns? Is this the kind of clinic that I identify with, as a good culture and a good fit for me as a practitioner and an owner? So inventory sales, your average doctor transactions, production reports, cost of goods sold, all of those things are very important. What does the growth look like with new clients? And so you'll want to ask for some of those as well.
We have another question.
Yeah.
Is 3 years tax returns necessary? Can you just use the income statements?
Yeah, so great question. And yes, the tax returns are necessary. The reason that those are necessary is, I sort of mentioned before, you could put anything on a profit and loss statement. You shouldn't. Obviously, if you want to take a good look at your practice, those should be accurate, and reliable reports. However, there's really no check to say, oh, these are true or not, right? And so because of that, we require the tax returns because that is what has been turned into the IRS. We will then go back and request IRS transcripts to verify that the financial information that we've been given about this business and the decisions we're making about this business are actually true. And so we will verify the tax returns. The profit and loss statements are difficult to verify. In addition to that, the profit and loss statement may not show you items like amortization, the taxes that you're paying. It may not show you depreciation, some of those accounting things that will be done in order to help that owner on their tax returns. When we look at that, we're going to need to add some of that back and make adjustments there. So we'll definitely want to see the tax returns. So as we move further into the valuation, we've gotten all the information that we need as far as the document, so we can start to look at this. But now we need to figure out, okay, well, what do I do with that? What does that mean? And so there's a couple of accepted methods for just sort of quick and dirty, valuation of a practice. One is the second one listed on that slide, and it's the gross sales method. This is an older method. We don't really use it. It's not as accurate as it used to be, but there are a lot of owners out there who will say, well, my gross sales are 1.5 million. And so I want 1.5 million practice. Okay. That might happen, but more than likely it's going to be less than that. Okay. But we need to dive in a little bit deeper and look at those things we've just talked about in order to determine that. So we're going to use a multiple of cash flow most often. Okay. And we do want that to be EBITDA if possible. Okay. And what happens is, based on the cash flow, let's say that was $100, then we would multiply that times, a market average multiplier. Right now, we're seeing anywhere between 4 and 5 times. Okay. So 2.5 is a little bit low. We do see that occasionally. Occasionally, I see 5.5 or a little bit higher. Okay. But, 4 to 5 is really average right now in the market. Now, these are for individual buyers. Corporate purchases, they don't need banks. They are not worried about being able to service a debt. And so they will outbid you. And so, be aware of that. Do not get into a bidding war with corporate. But, it might be that you need to look for a different opportunity. Okay. So keep that in mind and don't get emotional. Be sure you're making a good business decision. So we'll walk through just a real quick example. And so on this example, this would be kind of a little summary of part of a profit and loss statement, of an income statement. But let's say what I want you to look at, and if I think one more click, Amber, and it might highlight those salaries for me. Salaries and wages there for non-DVMs and DVMs. And so that's important. And I want you to take note of that, because what I want to do is encourage you to really think about the difference in the financial freedom associated with ownership. So you've got non-salary wages there, and then you've got your DVM wages. You've got 3 DVMs, and it's $264,000 between all 3. Okay. The other item I want you to notice down there is the expense, the lease expense. Okay, that's $70,000 a year. Keep that in mind, because we're going to switch up the example a little bit at the end, and that number will be important. So at the bottom, what you can see is that you've got net profit of $225,000. So we've taken out all expenses, all of that is done. And at the end of the day, there's $225,000 left in this clinic. Okay, we're feeling good so far. So based on the cash flow method, okay, that income approach, we're use a 5 times multiplier of that net profit to come up with the total purchase price. So the total purchase price is $1,125,000. Now, that's not your loan amount, okay? That's the purchase price. So now you may have to, you're going to have bank fees, closing costs, you may need working capital, you're going to need to put 10% down. So once we've done all of those calculations, you're going to end up with a bank loan of just over $1.1 million. And you can see that number right there at the bottom. Okay, so let's assume, unfortunately, 6.5% is going to be a little low right now. I would love it if I could still give everybody that, but interest rates are going up, but we'll use that for the example. And you can see there that the yearly payment is almost $156,000. Okay, so remember our number, our net income was $225,000. So there's plenty of money there to service that debt. Okay, so $225,000 minus that yearly payment leaves you just over $69,000. So as the owner, that is the money that you have remaining after you've serviced all debts, all expenses, everything is paid. You also, though, get that DVM salary because there's 3 DVMs and you're practicing. And you remember we had calculated salaries. So it's 88,000, times 3. And so 88,000 of that goes to you. So now instead of making 88,000 as an associate vet, you're making over 157,000 as that DVM owner. Okay, so let's change it up just a little bit. One of the things that scares people is when real estate gets involved. A lot of people sort of panic, the loan amount gets larger, but I want to walk through this example and encourage you to at least explore that opportunity, okay? So let's say now that we've added the real estate, which is just over $450,000, okay? That purchase price, that is totally separate from what the clinic is worth. So there's going to be a value on the clinic, the practice, that will include fixed assets and goodwill. And then there will be a value associated with the actual real estate where the practice operates, okay? So that new bank loan is $1.6 million. The yearly payment on that, it's only $167,000. And you say, okay, well, that's not that much more. What happened? Same interest rate. But the difference is when the real estate is involved in the transaction, we can extend the term of the loan. Business loans are typically 10-year term loans. When real estate is involved, we can go above 10 all the way to 25. Okay, and that depends on the value of the real estate compared to the value of the practice. In this case, we're going to do a 15-year term. Okay, that's why that payment is just over $167,000. Okay, so now we've got to take that same $225,000. So our net income did not change. $225,000. We're going to subtract our yearly payment. Okay, so we've got almost $58,000. But remember, I told you one of the important expense items, which is often a very large expense item, is the lease. Well, now that's being paid to you. Okay, you don't have that expense that you're paying to a landlord. You're paying that to yourself plus your DVM salary. Okay, so now your total owner's income is almost $218,000 compared to your associate DVM salary of $88,000. So this is a little bit of food for thought. This is, how do we use those numbers? When we're looking at that P&L, what's important to pull out? Look at the lease, look at how much you're paying for rent. Is the real estate available? How much are we paying our DVMs? What is that net income? And again, remember, you benchmark all of these against the national data to figure out, how you're doing compared to other practices. So hopefully this example has been helpful. We have a ton of other resources But either way, whether you're a turns versus earns practice, either way, these financial principles are going to be the same, and you're going to be looking at the same numbers. You just may be looking at them a little bit differently based on the type of clinic that you're practicing in.
Thank you so much for going over all of that. It's always fun to see how the numbers differ and what you can do with it. We hope that you will reach out to us either today, tomorrow, or maybe further down in the future. We definitely love having conversations with everyone and just seeing where everyone's at, whether that's about potentially opening up a practice, life, whatever it is. We would definitely love to talk to you guys more. And I did forget to mention in the announcements earlier, we do have a QR code to get Race CE. As always, it's at the end here. Take a picture of that. I will leave it up for right now and see if anybody has any questions in the meantime. I will give it another minute before we conclude. I'll put up our contact information in case you don't want to ask here. You are more than welcome to email us. All right. Well, I will go ahead and end the webinar. And thank you so much for joining us tonight. And for all of you who have been through episode 1 to now, thank you for joining us through this journey. We hope that you learned a lot. And if you, like I said earlier, if you have any questions about pretty much anything, let us know. We'd love to talk to you. Have a great night, everybody.